Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher Panayiotou, certified financial planning professional, the Cap in Capitalize. And on today's episode, on behalf of Halloween week, we are going over 13 scary retirement stats. But before we do this episode, which is going to be a little different than past episodes, the free advice for the week, as always. And it's a little twist on Halloween. Again, I'm already prepping myself for the dad joke, but it's the best I got. Be fearful when others are greedy and greedy when others are fearful. That's one of my favorite quotes from Warren Buffett. And that's it. That's all I got to say on that. So let's get into these 13 scary, retirement stats. Kind of stuttered there. So the reason that this is going to be a little different, my team sent me these beforehand, but did not want me to look at these until the episode. And so I'm going to be responding to these in real time, and I'm going to be giving my own take on if it's truly scary and what you need to do to make sure you don't fall into these scary traps. So with that, I'm going to open this up in this link and respond to these in real time. So the first scary retirement stat, more than 4 in 10, so more than 4 in 10 younger workers are living paycheck to paycheck. As Goldman Sachs report shows, more than 42% of Gen Z, millennials, and Gen Xers state that they are living paycheck to paycheck and are currently unable to save for retirement. Okay. Yeah, that's that on the scary scale, say that 10 times fast. Admittedly not as scary as I would have thought, but and it's also not as shocking when you talk about like Gen Z and even some millennials. When you're just starting out, a lot of people are just figuring out as they go. And I'm not discrediting anyone's fear that is living paycheck to paycheck. Let me be crystal clear, because things are more expensive. I get that. I will say though, just due to professional experience, a lot of people may be living paycheck to paycheck. And if you're not watching, I did air quotes on that, because there are a lot of expenses that you are paying for that you are otherwise not aware of. And so there's just a couple tips and tricks that I would say for you or that I would give you to get around the paycheck to paycheck feeling. So number one, analyze your expenses. Go back and analyze the average 3 months. Separate your variable and fixed expenses into, and you could use an Excel spreadsheet. You could just use good old pen and paper. Sometimes old fashioned is best. And the fixed expenses you can't get around: rent, water, food. Obviously groceries can be relative. There can be a range, but you gotta eat. But then everything else, sometimes you got to tighten up a little bit. And that's okay. Maybe you don't have that splurge on an Amazon Friday night binger where you're maybe 2 glasses of wine's deep and you probably shouldn't be on the computer in the first place. Maybe you need to cut back on going a little bit more extravagant in the gift department for friends and family. That's okay. Maybe you do something handmade or an experience. Our family's really big into experiences for birthdays or Christmas or what have you. One thing I want you to think about when it comes to paycheck that will hopefully alleviate your fear. Paycheck to paycheck is not necessarily a bad thing. So think of it this way. I've had people, not so much now, but early on in my career, and then people will DM me and they'll ask me questions saying, I'm living paycheck to paycheck. And I go, okay, well, explain your situation. Are you putting money into your retirement plan? They go, yeah, we're putting money in up into the match. So maybe dollar for dollar up to 4% or 3% or whatever that dollar amount is. And I go, okay, well, do you have an emergency fund? Yep, we've already got that. Okay, well, you don't have like credit card debt. You've got a home. So you've got your mortgage or you're renting, whatever, that's fine. And then you start to realize, okay, you are living quote unquote paycheck to paycheck, but you are moving your needle just by putting money into your 401k up into the match. You're getting free money on that. And that's all sometimes that's all it takes. Yes, sometimes that's all you can afford to do so, but you extrapolate that over 10, 20, 30 years. You're going to be thankful that you lived paycheck to paycheck during that period of time. So, again, 4 in 10 younger workers living paycheck to paycheck. Is it scary? Yeah, I get it. But I bet you a lot of those people, if they actually go back and look at the expenses and where those expenses are being allocated to, you can alleviate that fear pretty quickly. So number 2, 7 in 10 who experienced a major financial event have reduced retirement savings. So this survey shows 66% of Gen Z and 59% of millennials experienced at least one major financial life event in the past year, which could be positive, like buying a new home, or negative, like, divorce, natural disaster. But regardless, 70% of that group either paused retirement contributions or took a loan or planned to retire later or decreased their savings. So again, going back to the top of 7 in 10 who experienced a major financial event have reduced retirement savings. I still don't think it's that scary because sometimes you got to take 1 or 2 steps forward to take an infinite amount of steps ahead. And I'll give you a real life example. 2 years ago, we had a client come in, and husband and wife, and they were, again, living paycheck to paycheck. They were saving for their retirement, but again, they couldn't figure out how to get rid of some credit card debt. They made a stable amount of income. They wanted to eventually be able to max out their retirement. But it just, for whatever reason, wasn't in the cards. And I remember I looked at their situation, and the huge lever that they had that they could pull was they had a home, and their mortgage was of higher interest rate as opposed to what I knew they could get. And so what they ended up doing was a combination of things. They were able to take out a line of credit, and they paid off all of through their home. They paid off all of their credit card expenses, but then they didn't want to have that line of credit anymore. And so then they took that extra cash flow and they actually decreased their retirement plan contributions to just where the match was. And all that extra, they paid off their line of credit, and then they were able to max out their retirement plan in the next year. And they've been doing that ever since. So it's one of those things where, again, in the moment, they had to reduce their retirement savings, but really they weren't. They were shifting it to another investment, because really paying off debt, it is an investment. If you have a credit card of a 27.99% interest rate, yeah, that sucks. But think about this. Every dollar that goes towards paying down that debt, you are paying that rate of return on the interest rate that credit card is. Again, I'm not inspiring you to go drown in credit card debt at that interest rate. But what I'm saying is, if you have those cards that you're dealt with, sometimes you need to take a step or two back. And that's okay. So again, so far, not that scary. Number 3, retiree inflation is running 1 percentage point higher than general inflation. So the cost of retirement is outpacing inflation, according to the report, with expenditures among retirees from 2000 to 2023 rising an annual rate of 3.6%. This is a full percentage point higher than the general 2.6% cost of living or inflation adjustment measured during that same time frame. I'm not afraid of this one at all because of a couple things. One, generally speaking, I'll just speak for myself. When it comes to interest rates or inflation, when it comes to planning, generally what I do is I account for inflation of around 3%, which historically it's been about 3.1% over the last 100 years. So, because again, 2000 to 2023, I'm not saying that's not a long period of time, but even with that, you could say that there were some financial big bumps in the road. If you extrapolate over 100 years, I think that's a more accurate average. So about 3.1%. And I also don't get as nervous about this one because, again, from a planning standpoint, if you're about to retire or have already retired, here's a huge misconception. People assume when you get to retirement that you suddenly need to move money more conservatively into investments such as bonds or CDs or money markets or annuities. And to a degree, that may be true. But here's something you need to know. Just because you've retired doesn't mean you're dead. So you need to have money invested in some way, shape, or form for that long-term growth rate, whether it's the stock market, private equity, real estate, etc. So by doing all of that, even if you have your emergency fund set aside, and even if retiree inflation is slightly higher, I'm still feeling pretty confident you're going to beat that 3.6%. So again, so far I'm not all that scared. So I'm giving you some confidence here. Number 4, nearly 6 in 10 workers expect to outlive their retirement savings. Okay, this is terrifying. Almost 7 in 10, so 68% of workers surveyed said that they are at least somewhat confident that they will be able to meet their retirement savings goals, though just 34% are very confident. Yeah, that's not good. That is not good. And you know what? This actually, I'm going to try not to get too unhinged here and go off on a tangent. This stat is terrifying. And it's terrifying not because of the consumers. It's terrifying because my industry does such a piss poor job at educating people on actual planning principles. No, investing is not planning. There is a huge difference. Huge difference. And if my industry just stepped it up a little bit, this fear of 6 in 10 workers expecting to outlive their retirement savings, I don't know what it would be down to. I bet you it could get down to 2 in 10 because it's just lack of education. It's lack of education. I mean, that's why I get so fired up when I go and I speak at these companies or bureaus or what have you, because I can't help everyone, but at least by giving and gifting the stewardship of the principles that I've learned, I've done all the heavy lifting on that regard and gift it back to the consumers. Hopefully all of you out there can go and talk to planners and talk to advisors and get them to elevate themselves. So again, that fact, scary as hell. Now we are on to number 5. More than 6 in 10 say caregiving prevents adequate retirement savings. Okay, I want to read this one a little bit more. Among the biggest financial pressures putting stress on workers' ability to save for retirement is caregiving and otherwise financially supporting family members. Okay, because that could mean like little kids or adult parents. In the survey, 62% said caregiving responsibilities of this nature are harming their ability to save for retirement. All right, so here's a really easy one to alleviate that. Long-term care. Long-term care insurance is not what it used to be. And you could say for better or worse, but I would argue the majority of it's for the better. So back in the day when like my grandparents were looking for long-term care was very cut and dry. You bought this long-term care insurance, and if you used it like they did, it was phenomenal long-term care insurance. Like I could argue If my grandma and grandpa did not have long-term care insurance, because my grandpa passed away first, then my grandma a year later, they probably would have ran out of money 3 years before they were both gone. But because they had that, it was phenomenal. The bummer, though, was if you didn't use it, it was just gone. You lose it. Now, the insurance companies, to their credit, have they've woke it up and they've gotten a little smarter with these policies. So the whole generation of hybrid policies have become prevalent. And so how those work is you can use them for long-term care or traditional life insurance. So, and I'm just going to make it really easy. Let's say you bought a long-term care policy for $100,000. You've spent down $40,000 of it and you're dead. So now you've got $60,000 left, and then that becomes a death benefit that goes to your heir or heirs, in which that you put the beneficiary, you write it down accordingly. With long-term care, it's also easier to afford today versus back in the day. So back in the day, you had to have just a fat sum of money lying around, and generally like the minimum was, $50,000, and you'd have to cut the check and go on your merry way. Nowadays, and granted, if you come to an insurance company with $50,000, they will kindly take your money, but you can work backwards on what you can afford. So you could pay on a monthly basis for your life until you start using long-term care. That would bring down the price per month. But again, you're paying over your entire life. One thing that's really popular in my practice is we do something called a 10 or 15 year pay, where you pay a set dollar amount for 10 or 15 years. And then the long-term care policy is what we call fully funded. So then you're not paying anymore at that point until you use it down the road. And instead of paying, then you obviously take money out. And I've just noticed clients like that, because you can have your cake and eat it too. You can fund it, but then you see the light is at the end of the tunnel. And by light, I mean you're no longer paying, not that you're dead. And then the policy, it's growing on its own, so you don't need to put any more money into it. So I get the fear. I totally get the fear. This is a legit fear, but this is a preventable fear. Very preventable fear. Number 6, nearly 6 in 10 say debt is interfering with retirement savings. So behind caregiving obligations, the next most common issue affecting retirement savings adequacy amongst workers is paying down existing debt. So if we dive a little bit more into it, 58% say high interest credit card debt is to blame. 57% cite student loans or similar lower interest debt. Okay, so there's a lot to unpack in that. The 58% with high interest rate credit card debt, totally get it. You should be scared to death because you're never going to beat that interest rate on the credit card. And it is affecting your retirement savings. Now, a couple ways to go about it. If you have a company retirement plan available, assuming you're an employee, you want to put money in at least up into the match. That is a guaranteed rate of return on your money. If it's dollar for dollar, that's 100% rate of return, because again, they're matching at 100%. If it's 50% on the dollar, that's a 50% rate of return. 25%, right? 25 cents for every dollar, 25% rate of return. Whatever that percentage is up to, you want to put in up to that amount, and then anything left over, you are going to order your debts from highest interest rate to lowest, and you're going to knock out that highest interest rate. Then you're going to avalanche what you were paying into that, into the next one, into the next one, into the next one, until you get to the point where your debts are at a 6% interest rate or lower. And this is where I disagree with the lower interest rate debt people, where they say, oh, that's dragging me down. What did I say earlier? When you're paying on a debt, that is the rate of return on your investment in which you're paying. So if your credit card debt's 27.99% interest, you're earning a 27.99% rate of return, so on and so forth. But let's say you've got a car loan and it's 4%. Let's say you got a student loan and one of the student loan tranches is 4.5% or 5%. The reason why I say anything lower than 6 is when you have interest rates on your debts that are lower than that, in the long run, again, I can't guarantee this, again, due to compliance. There has never been a 15-year period, though. This is in my first book, available for $19.99, available on Amazon, right next to me. That never been a 15-year period where long-term investments have done about 7.94%, call it 8. But I want to be a little bit more conservative with that number, as well as be cognizant of taxes, as well as bring in the fact that the first 3 guests that I had on my show, all doctors, David Blanchett, Wade Pfau, Michael Finke, 3 of the top researchers, financial planning researchers in the world, wrote this amazing white paper, and I'm blanking on the name of it, saying that the next 50 years from now, investments as a whole will not perform as well as they have over the last 50. So that's where I get to that 6% number. And so once you get to that, any extra cash flow that you had from the highest interest rate debts, you will, instead of reinvesting those into those debts, you will go and shovel that back into your retirement plan. And then if you've already maxed that out, then you could go and open a backdoor Roth IRA. Then you could then you could max out your HSA if you haven't, and then you open up an investment account. But the whole concern with the debt side of things, I get the fear, but now that you know what I told you, it is an illogical fear, and been around my near 3-year-old for way too long, and it is very preventable. So we're going to take a quick commercial break, and then when we come back, we're going to go through the rest of these fears. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. We're going to get back into the 13 scary retirement stats to read, and in the dark. And we're on to number 7. Nearly half are prioritizing college savings over retirement savings. I am mixed on the scared department here. Part of it's scary because of what I know. The other part, it's not that scary. It's also kind of understandable because also when people are very cognizant of saving in general, sometimes their saving is misguided, but like they've got good principles built in. So they're still going to be able to pivot pretty easily. Here's the scary fact that you need to know when it comes to college savings. And for those of you that are prioritizing saving for your kids' college over saving for retirement, how much help can your kids or grandkids get in college financially? A lot. Private loans, public loans, grants, scholarships. They can work while in school to pay some of that down. So there's a lot of help that they're going to get in college, in theory. Who's going to help you in retirement? You don't get help in retirement. You've saved what you've saved, and that's that. So for those of you that are prioritizing the college savings over retirement savings, you're going to have to figure that one out and flip it. And maybe there's a balancing act. And I'm totally okay with the balancing act of things. Again, If you're putting more money into your company retirement plan, maybe you knock down the contributions up into the match and then take that extra cash flow and set it towards college savings, whether it's a 529 or a Coverdell, things of that nature. But again, don't prioritize 100% college savings over retirement, because then you'll get to retirement and you'll go, oh boy, I'm screwed. And that is scary. Number 8, only a minority of savers are targeting a 70% income replacement rate. So let's read into this one a little bit. So survey results show optimism is relatively high amongst retirement savers, but that masks a worrying issue. That is, intended retirement income replacement targets may be too low to sustain current lifestyles. A large share of respondents aim for less than 50% of working income in retirement, and only a minority target more than 70%, a benchmark many financial professionals cite as necessary to maintain one's standard of living. Okay, so let me translate all of that. So when you get to retirement, that whole 70% income replacement rate, basically what that means is, so you need your monthly expenses, and let's say that you have all of that covered in your current day-to-day job, but then as of retirement, your retirement will only cover 70% of that, and then Social Security can help supplement that and get that remaining 30, so your 100% is cleared up. So that's been the whole frame of reference on that. Again, I get the fear, but and also, you know, these stats are they're much more general in nature. They're not specific to an individual person or couple. But I'll tell you that the whole 70% income replacement rate, I don't worry about that as much. It really comes down to, what do you actually spend? And then here's another thing. That all may be true right now, but let's say that you have a home loan or a boat loan or a car loan, and in 5 to 10 years in retirement, all of those are paid off, and that frees up a ton of cash flow. And so that may be true today, that you may be like under, but then when you actually run through a planning calculation, your plan, it actually is going to look totally fine in the long run. And this actually brings up a point that I think is worth mentioning that doesn't get mentioned a lot. I have seen people time and time again where they come into my office, and for the majority of people in retirement or about to retire, if you can delay, Social Security as long as possible, ideally up to 70, do so. Because between 62 and full retirement age, call it 67, your Social Security grows at about 5.5% a year. But then from 67 to 70, it grows at 8% a year. Saying that another way, if you wait till 70 as opposed to 62, you will have a 50% higher payout at 70 as opposed to you taking it at 62. And the break even is about 82 years and 3 months. So, you know, if you died before then, you probably should have taken it earlier. But on the flip side, you're not going to worry about it because you're dead, which I guess fits within Halloween, scary, you're dead, woohoo, whatever. So, having said that, the whole like targeting 70% income replacement rate, let's get a little bit more practical with that. That's it's a fluid number. So think about it from a planning standpoint. I've written plans for this for clients. I can think of a number off the top of my head where they retire at 65 or 66. They're not going to take Social Security till 70. So they're tapping into principal at that point. So between 66 and 70, their net worth is decreasing. And in some cases, not substantially, but, you know, amount where they kind of pucker a little bit. But then you get to 70 and their plan, it's like a J curve. It just booms up into the right. Why is that? Well, by the time they get to 70, they turn on Social Security. Therefore, they don't need as much from their portfolio. And Social Security is a weird income where it's sensitive to other incomes that you have from a tax perspective. So when you decrease your retirement income and distributions from your IRAs or your 401k, basically pre-tax accounts. What happens is then your Social Security, the income looks around and it's not taxed as aggressively. Therefore, you don't need to distribute as much. Therefore, you can take whatever's left over and invest it for the future. Therefore, your plan in the long run is going to look fine. But it could be that short window where, you're just going to take a couple steps backwards. But again, I've said this in the past. I think I said this last episode, if I remember correctly. They all become a blur. Sometimes you got to take 2 or 3 steps backwards to take an infinite amount of steps forward. So again, so far, not scary in that regard. Okay. Number 9, more than 1 in 5 retirees are living on less than 40% of pre-retirement income. According to the survey, some 21% of current retirees are living on incomes that are below 40% of their pre-retirement income, and that includes Social Security benefits. Another 19% are living on incomes between 40 and 50% of pre-retirement income. So again, I'm not scared about this one, because let's say you're a doctor and, I can think of, and let's say you're a specialist. Let's say that you're a gastroenterologist, and, at the height of gastroenterologist careers, I mean, some of these doctors are making $1 million a year. They're not living off of that. They're not living off of close to that. Maybe they're living off of, I'm going to make a number up, $150,000. And so when they retire, of course, they're living off less than 40% of their pre-retirement income because they didn't need all of that. They've saved all of it. Now, what can get scary is if you don't have a choice and you're penny pinching and now you're living off of 40% of your income that you had before you retired. That is freaking terrifying. But with these surveys, and again, SoFi put this one on. I want to dive more into that one, but at first glance, I'm going, no, because most people live off of less than what they were earning when they were working. Because a lot of people, think about this, when you're working, generally you're saving for retirement, or you're paying down your mortgage or student loans, or you're paying for kids or whatever the case may be. But then when you retire, eventually everyone's off your payroll and you can do your own thing. So, which means you're not going to be spending nearly as much. So at first glance, I'm not as scared. I mean, we're coming up on 10, and so far I have not been particularly scared. I mean, there was one that scared the daylights out of me, but I'm feeling pretty good. Okay. So number 10, just a third of current retirees are living with incomes above the traditional industry target. So financial professionals generally advise their clients to target retirement incomes of 70% or more of their late career working income. And this one's actually from Goldman Sachs. The Goldman Sachs survey shows that the reality is not remotely close. Just 33% of current retirees have that. Specifically, 14% have achieved incomes between 71 and 80%. 9% have achieved incomes between 81 and 90%, and 10% have achieved incomes above 90% of what they were earning in their later years. This kind of falls into the other one. I'm a little disappointed. I was hoping for some fear. I wanted the fear of God to strike me in this list, and it's not that scary. This should be music to your ears, because think about this. A lot of people think when they get to retirement, and I see this in my office, they come in, people come in and I go, well, how much do you need to live off of in retirement? I remember one time a couple came in and they said, 20 grand a month. Like 20 grand a month. Really? I mean, I'm not judging, but like, because I looked at everything else before and I'm going, are you sure? Like, where'd you get that number? I'm just curious. And they looked at each other and they're like, well, I mean, that's what we make gross every month. I'm like, no, 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 no. What are your monthly expenses? And that's when they started digging into things. And then for this particular couple, they didn't need 20 grand. They needed like 7. Because again, they were, even with gross, they were making above and beyond 7. They were saving for retirement and investing and all that fun stuff. So my point with that is most people, when you peel back the layers, you're actually not going to be spending as much in retirement versus what you were making when you were working. Okay. So again, not scared. Number 11, 4 in 10 highly affluent workers aren't saving for the future. Bro, that see that not only is that scary, and I'm trying not to laugh because it's not funny, but like it's so scary that it's almost comical. This is one thing I've never seemed to understand is the whole keeping up with the Joneses mentality. I get it when you go from paycheck to paycheck to having a little bit of cushion, or in some cases, a lot of cushion, and you want to level up your lifestyle a little bit because you want some breathing room and you want to reap the benefits of your hard work. I think that's totally valid. And I think every single one of you should experience that and should go for that once you hit that milestone. And I'll leave you to determining what that is. But there does come a point where after the dust settles and you look around, you go, well, I don't need to keep leveling up my life. Because once you make a certain amount of money, you're good. You're good. Yeah, I may be able to buy you certain things. And some people have higher standards than others. And that doesn't mean that you're better than others. It's just different. Like some people want more simplistic lives. Fine. Great. In fact, I think some of those people are the wealthiest out there, not by dollar amount, but just by their life. But 4 in 10 highly affluent workers aren't saving for the future is beyond terrifying. It's beyond terrifying because those people are going to get hit so hard in the teeth with reality when they retire or when they look and they're like, man, all right, I'm about 12 years out from retirement and they've got nothing. And they're making, hundreds of thousands or some cases millions of dollars a year. Now, the only exception I would have off of this is for those of you that run a business and eventually you're going to sell your business and retire. Because in a way, sure, you're not saving for retirement, but you have a boatload of value in your business. And then when you sell that, you're going to hit this huge windfall of money. That is the only exception that I would say is completely acceptable for that 4 in 10 highly affluent. But like if you're an executive or you're like a tech exec or, an engineer or I don't know, like, an attorney at a law firm that's doing well. If you are highly affluent and you're not saving at all, you should be scared to death. Okay. Scared to death. Number 12, coming down the home stretch. Only about 1 in 10 people contemplate retirement savings without stress. So the survey shows that, and this one's also from Goldman Sachs, nearly half, so 49% of workers find managing retirement savings stressful, while only 11% find it without any stress at all. The remaining 40% neither feel positive or negative about it. They're just completely agnostic. All right. I mean, that's not shocking to me. I get the fear. I will say I do get the fear on that because going back to my little rant before the commercial break on how this industry does such a piss poor job at educating people on planning principles, you should be scared because you're going, you're just kind of running naked and afraid, and our industry isn't doing you any favors. So that's the industry's fault. That's not your fault, the consumer. But I also would say, even if you do have a quality planner out there, which admittedly I hate saying this, but like there aren't many out there, relatively speaking. Okay. And I can speak personally on that, but that's for another time. Even if you do have a quality one, some people just get afraid of money. And I get it. Like money is a huge responsibility, especially if you have a decent amount. And in many cases, if you have a lot of it, because you are, generally speaking, the wealthier you become, it becomes less about you and more about your circle. I don't want to say entourage. It's not like you're some athlete that's just like buying things for everyone, but you kind of do become a walking economy in a way, because you're helping out with people, and whether that's just being a wealthy individual, or if you're running a business and your business starts to become more successful, next thing you know, you're helping people. You're paying for, I mean, personally, I can think of a number of things. You're paying for your tax professional, which is needed. You're paying for your state attorney, which is needed. You're paying for, in the business, like, of course, I pay for marketing, the best marketing officer of all time, unbiasedly, of course, it's my brother, and I've got an amazing teammate. Yeah, like as I'm saying this, I think about a lot of people that money goes to different places and all that, and when we first started, that was not a thing. But if you don't know how to manage a lot of that, and be like a excuse me, a like a financial officer, a chief financial officer of your life, yeah, it's totally scary because you're running dark. But there are easy ways to get over that. Yes, you could hire a quality financial planner out there, and there are those people out there. There's also a lot of tools. I mean, go to capitalizepodcast.com. There's a ton of either free or really affordable things that you can use to get over that fear. But here's one thing. I can't want it more than you. You've got to do the work. Like at some point, if you want to conquer a fear, you've got to be the one that's going to have to do it. Now, the last one. Oh, okay. Well, I should probably read it. Life expectancy at 65 is nearly 20 years. This is another Goldman Sachs report. So life expectancy for a healthy 65-year-old is longer than ever and forecasted to increase. In 2000, for example, the average unisex length of retirement was 17 and a half years. And in 2023, the number was 19.2. By 2033 and 43, it may be 20.4 and 21 years, respectively. Longer lifespans come with many potential benefits, the report notes, but they also raise the cost of retirement significantly. Okay, so yeah, death is a scary thing. I mean, I could actually argue both ways on that. Personally, I don't fear death like I think a lot of my colleagues do. I fear it more so because I wouldn't be able to be there for my family. But in and of itself, like for me, I mean, I know I'm going to be good. What I will say is because there is a little bit more to unpack here. Yes, as you get older, the cost of living with healthcare and long-term care expenses, that does rise. However, when it starts to get like really, really, really expensive, you're probably already dead. So it's pretty short-lived. I can also tell you that generally speaking, the more financially stable you are, the longer you're going to live. And there's quantitative reasons on that because you can afford maybe nicer foods, nicer homes, better care, things of that nature. There's also the quality aspect of it. If you're not worrying about money as much, your blood levels are going to be probably better because your cortisol isn't raised. You can have a clearer mind. And when you have a clear mind, you can think more freely. When you can think more freely, you're going to be happier. And then when you're happier, you are probably going to live longer because I can tell you some of our clients that have lived a very long time. The difference between those that do and those that don't, It's mental. Sure. I mean, if you're diagnosed with something that is like life-threatening, yeah, that it's pretty hard to dodge. But on average, I have noticed that the most successful people, and the oldest people that I've worked with, yes, they've had a successful life financially. I mean, that's what I do, but qualitatively, they have some of the best lives around. And again, it doesn't mean just money. So yeah, is death scary? It is, but it's inevitable. So because of that, I'm not as scared with that last one. And this was a lot of fun. Let me know if you want me and my team to do more episodes like this in the future. And that does it for today. So as always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing and happy Halloween. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris@capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made to its accuracy and completeness. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Money market mutual funds, though traditionally lacking federal insurance, are not without risk and are highly regulated under federal law. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Stock investing includes risks, including fluctuating prices and loss of principal. Investments in real estate may be subject to a higher degree of market risk because of concentration in a specific industry, sector, or geographical sector. Other risks can include, but are not limited to, declines in the value of real estate, potential illiquidity, risks related to general and economic conditions, stage of development, and defaults by borrower. Long-term care coverage policies and provisions may not be available in all states. Approval may be subject to the terms and conditions of the insurance company. Insurance product guarantees are subject to the claims paying ability of the issuing insurance company and are subject to their terms and conditions. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount at the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. Prior to investing in a 529 plan, investors should consider whether the investor's or designated beneficiary's home state offers any state tax or other state benefits such as financial aid, scholarship funds, and protection from creditors that are only available for investments in such state's qualified tuition program. Withdrawals used for qualified expenses are federally tax-free. Tax treatment at the state level may vary. Please consult with your tax advisor before investing. Coverdell accounts can affect financial aid significantly or not at all. Withdrawals from Coverdell accounts generally are tax-free to the extent that the amount of the withdrawal is not more than the beneficiary's qualified education expenses. The information provided is based on current laws which are subject to change at any time. Capitalize Your Finances is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. The people and/or companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442.